One. Hello, everyone. Chris Martinson here with another episode of Finance University, and back with Paul Kiker of Kiker Wealth Management. Hey, Paul, how are you?
I'm good, Chris. Good to see you again.
Yeah, likewise. So much to discuss. Last time we did talk about some of the great taking. It's kicked off quite a flurry of inquiry and questioning within my tribe. Also, outside of the tribe, I've received a lot of phone calls this past week from people who are concerned, have questions. We're still digging to see what kind of answers we actually can get. And it's been fascinating. So I can't name names. I can't even talk entities, but I will say that someone I know, and he knows who I'm talking about, went to their fiduciary trust corporation, right? So they're in a fiduciary, and the fiduciary said, "Oh, don't worry about it. These are 100% not on our balance sheet. Good to go. They're yours." So I was like, it was a whole page and a half of explaining that. And I was like, why don't you ask them where those shares are registered? And then they came back and they said, oh, you mean that? Yeah, they're with Seed Incorporation and DTCC, right?
Oh, they did begin to state that. Okay.
They did state that. And so then it's like, and let me ask the follow-up question, which I shouldn't even have to ask, which is, if they get in trouble, what's my exposure, right? It just should not be like pulling teeth at the dentist without anesthetic. These should be simple questions
Yes.
and simple answers. So it's been interesting just to see people trying to get answers, and we'll get there, but it's interesting to see the reticence of the system to be transparent.
It really is. And I've run into kind of the similar situation. At first, everybody's like, oh, it's nothing to worry about, and then you ask that extra question and Seed Corporation comes up again. And then there's shock and silence, like, okay, we don't know how to answer this. So I think everybody's just been busy working along, and in the background, they've been doing their thing. And hopefully the more people that are informed, the more pressure that we can put on the regulators out there. So interesting.
Yep. Yeah, no, it's interesting. And obviously we're going to have to keep digging. I've been doing a lot of digging to try and get to what do we do? And it's very much not obvious and not simple. I mean, I think David Rogers Webb is correct. The thing you do is you undo these laws, right?
Yes.
That'll take time. The good news is I think enough people are activated, and people of prominence and means and power, once they catch on to this story, I think are going to go, well, that's weird, right? So maybe, but what do we do between here and the resolution of that is really the question at hand. So I actually think, Paul, that I think that this sort of is just what happens when you have the foxes guarding the hen house and nobody's really looking, right? Of course they write laws like this. Of course. Right. And I honestly think that the genesis of this was that they got really in love with derivatives, because derivatives made it appear like risk had been shot into outer space, and they loved them and they couldn't imagine life without them. So instead of going in 2009, bad idea, maybe we shouldn't have had these things in the first place, let's undo these. They found a way to satisfy these players so that they feel like, well, at least I can be positive that my hedging will get paid off. Now I can do more of it, right? And so you go from 2010, when the law was passed, to today, and you have twice as many derivatives, not half as many, right? So it went the wrong way. And now I'll bet you anything, nobody knows what, because if you could, let's imagine this, if you could snap your fingers, undo those laws, do you know how many risk models blow up and they have to violently undo those trades? And that alone could be its own adventure.
Yes.
Or misadventure, right?
Misadventure, I would assume. I mean, you take into consideration the average individual, the retail trader is using options like never before. You've got new products that are coming out, use derivatives and options to short the VIX. And, so you've got this whole casino that's taking place with the large majority of the participants that don't really understand at all the risk that's taking place behind it. So it's a major danger. And since this has come up, I go back and think about, okay, in 1929, nobody really considered that the banks could fail. Okay. A big recession, there wasn't a consideration of the need for FDIC insurance prior to the Great Depression, at least as far as I understand. But then you have the local banks fail, and it's equal opportunity misery for everyone across the board, except for those who had some assets that were outside the system that they were able to protect.
Yeah. Yep. So I know you're looking into this. I'm looking, a lot of people are looking into this. What I'm doing personally, and again, remember, all this is education, not financial advice. For me is I'm just going to have to study this before I figure out what I got to do about it. So I think that's the wisest course here is just let's study it. Let's study it hard. There will be some things I think we can do. There'll be ways to be less exposed, I assume. So we'll figure this out.
There will be, and for the average individual, you don't necessarily need a massive amount of resources. So, here's an interesting story going back to the Great Depression. How true family stories are, I don't know. I didn't get to ask the individual, but supposedly I had a great uncle, and 3 weeks before the banks failed locally, went and took $300 out of the bank. Just no specific reason, just had this little gut gnawing inside, and went, puts it under the floorboard at the house like they did back then. Of course, all the local banks fell. And all of a sudden, land went from $1.10 per acre down to a penny an acre. He took that money and reinvested it in land and started a lumber company back then, which actually carried through into World War II. Most of our family were dedicated to the effort of the timber cutting and sawmills, so that was their part of World War II. So you think about it, little resources, if everybody loses everything, if you have something, even if it's like the gold that we've talked about, not a recommendation individually, but if you've got some gold that you're holding on to outside the system as fire insurance against inflation, then that doesn't have a debtor. You're taking physical possession of it. That's something that gives you resources when someone else, other people don't have them if this comes about. But the one thing that I will say, and a lot of individuals I've talked to, there's no reason to make a panic decision right now. Think this through, take your time. The worst thing somebody can do is make a panic decision, liquidate, pay the, retirement accounts, pay the early 10% penalty, plus throw themselves into another tax bracket. And then this be something that doesn't come to fruition for 10 more years. So there is time to do the research, and I know you're on it. I actually started this morning going down an SIPC, the Security Investor Protection Corporation, which is it doesn't protect you against a foolish investment decision, but it supposedly protects you up to 500,000 against broker dealer failure. So that's this industry's equivalent of FDIC insurance for the banks. So, and I've learned an amazing amount this morning that I'm not necessarily ready to talk about because there's a couple of more questions that I've got to go through, but maybe that's something for assets that are still in the system that you can make sure that you're registering in the right manner to at least protect. At least then maybe you have the government backing that's behind, considering they may have helped design this. That may not necessarily be great, but at least it's something you can do to be prudent.
Yeah. So agreed. So we're going to keep looking into that. It's been one of the things that came up with David Rogers Webb. So I like to show everybody, just from finviz.com, how all the equity markets trade in lockstep across Europe, Japan, and the US, right? Doesn't matter which sector, doesn't matter which country. They're like minute to minute, hour to hour, day to day, month to month, year to year. They have this high degree of correlation, if not exact simultaneous behavior. And he just said, yeah, that just shows the simulacrum we're in, that the markets are not performing market functions anymore. The markets have morphed into this thing with the Federal Reserve, who I've been a huge critic of. Alan Greenspan, trashed him. Ben Bernanke, trashed him. Yellen, trashed her. I'm not as clear about where I fall on Powell yet, because he's trying to do some things, but he was also the guy who gave us the doubling of the Fed balance sheet because COVID, right? So that was kind of on his watch for sure. At any rate, but what I hated was that they always had these mealy-mouthed, mumbly, full employment, price stability, dual mandate. And I'm like, no, your mandate seems to be making the 0.1% richer, because that's the only objective data I can see where you're crushing it. Like that's a clear success. The price stability, not so much.
No, price stability, basically their efforts have been to destroy anyone who's run tactical models in the past or tried to operate and invest with what has been historically wise parameters to stay within your investment process. So they've both disheartened, wonderful, incredible individuals. John Husband shared some of the things that he's had to do to adapt to the underlying current that the Fed's put back there. And they're driving everybody into one direction for what I would consider nefarious purposes. I mean, I'd like to think that it was just simple foolishness, but it seems to be more than that, because they've really destroyed the markets to an extent.
Yeah, that nobody's that's dumb, stupid. But what they did was they punished anybody who had a fundamental aspect, right? So I'm a fundamentalist. I want to know. I mean, I cut my teeth back in the day. This is pre 2008 when everything started to go off the rails from, just computer driven speculative, momentum chasing, courtesy of the Fed. I used to go in and I made something of a specialty of reading annual reports and 10Ks and 10Qs and looking at things like understanding the cash flow statement and understanding what an accounts receivable might do on the balance sheet when it comes over into, the income statement, right? So I took time to understand that, because you can really, you can understand dogs from ponies in this particular. It's just totally useless behavior. It's irrelevant, totally irrelevant. And I deplore that, because there should be some fundamental grounding. And I think we'll get back there again. My hat would be make fundamentals great again,
Well, and two, you've got the rise of ETFs or index funds that have come along, and the popularity of the S&P 500 index. Well, those are price insensitive buyers. I mean, once somebody invests into the S&P 500 or the NASDAQ index in their 401k, they're overweighted the Magnificent Seven right now. And that just continues to feed, this absent-minded investing, I guess is the best way to put it. There's, we're just going to do what the herd does. And regardless of the underlying fundamentals of these stocks, we're going to buy them across the board. So the rise of those index ETFs and the popularity within 401ks, and the fact that since 2008, since January 1st, 2008, the S&P 500 is still or U.S. markets in general is only broad asset class that's positive. The general commodities, Goldman Commodity Index is still negative, emerging markets are still negative, and developed markets are still negative. So it's fed into this monster that's going to create some problems when it blows up.
Yeah. And so the problems also create potentially opportunities unless it blows up real spectacular. Then we have other issues we got to worry about. But so here's the positive side for me, although you have to be super patient to be me. I'm convinced that all of this speculation now creates real world difficulties. So let me just give you one example. I'm 99% sure that you're going to see oil close at or around $80 a barrel on Friday. Why? Because there's $80 billion of calls and puts saddled, and max pain, where most call buyers and most put buyers lose the most money, is at 80. And so now, to understand where oil is going, I just have to understand where are all the option players, right? It's a measure you can follow called max pain, which just says, where did most people lose the most money? And surprise, that's where the markets end up more often than not. I mean, it can sometimes, play out, but not usually. And it's really interesting to watch that dynamic take out. But while that's happening, I go and I talk to people in the oil business, and they're already starting to have to trundle off into tier 2 acreage in the Permian. And they can't do it at 80. It just doesn't pencil out, not with the inflation they've experienced both on labor and materials, particularly steel. So when you look at this, while the speculators are busy playing their fancy ass put call max pain game over here, which makes a lot of financial sense, the real world's over here suffering. And I think that creates an opportunity, because I look at that and I go, well, someday that's going to create a real shortfall in oil, and it's not going to be easy to resolve. And that means the only way we can resolve it is crush demand, which means the price has to go up.
Yes. Yes. Well, and that's where you have to look at the fundamentals from a long-term standpoint. What you've done such a great job of explaining to individuals is, to be successful in the long run in businesses, our lives, you have to make some sacrifices today for a better future. right? So
Mhm.
sacrifice today means you have to be patient. You have to deal with the emotional pain of your brother-in-law or your neighbor that's a little bit obnoxious to you, that's bragging about how well they're doing in the Magnificent
Yeah.
Seven. I mean, you've got some stocks that are going sideways for a period of time. But when you look at fundamentals like that, you say it's just simple mathematics. I don't know if it's 24 months from now or if it's 60 months from now. But if I take a portion of my funds and I set them over there from a long-term standpoint, and I'm willing to be patient, that's the sacrifice you're making for the greater reward in the future to protect yourself from the inevitable impact of what's coming.
Yeah.
So, and it is frustrating, especially because, gamma squeezes. Been in this business 25 years, and I didn't talk to anybody about gamma squeezes until really 2020, 2021. And we started seeing them in 2019 during that period of time. But it's like, at first I remember going, what in the world is a gamma squeeze? Like, I should know what this is. And
Mhm.
you pull out the dictionary and spend 2.5 hours figuring it out, and you're like, oh, I understand it. But how in the world are these driving the markets as much as they are? It's just because how large derivatives have become.
Yeah. For people listening who don't know, this is called knowing your Greeks. There are various Greek letters associated with options. There's put options, which is a bet that something's going to fall in price, and a call option, which is a bet something's going to rise in price. And both puts and calls have these Greek letters associated with them, and one of them is gamma.
Yeah.
And so the gamma squeeze, as far as I understand it, is correct. I may have this exactly wrong, but when a market maker or when a large participant has a huge position outstanding on one of these things, like let's say they've sold a bunch of puts, and all of a sudden it looks like prices are rising, they have to buy those shares to protect themselves,
Mhm.
because the gamma is the difference between, I forget what it is exactly, but it's some difference between what their exposure is and the price of the stock or something. So they have to buy. It's a forced buy of the stock because they have this derivative,
Yes.
and in order to not to lose their entire lunch on that derivative, they have to buy the stock,
Right.
something like that.
And the simple thing is it's force buying, right? Just the easiest way to explain it for the average individual. So you've got institutions that agree to a contract at a certain price. And then you have a retail army or an institution or someone at the margin that comes and drives that price higher. And then everybody's trying to mitigate the risk at that point, because theoretically, the market can move enough. And if you don't hedge that, buy insurance each day. And it's similar to the ability to buy hurricane insurance and flood insurance while the hurricane's headed towards your home.
Mm-hmm.
So imagine how you as an individual, if you lived in Florida or somewhere where a hurricane's coming and you have no home insurance, flood insurance, hurricane insurance, and all of a sudden you realize it's coming directly to your home. Now, insurance companies won't sell it to you, but in the markets you can. So what would you pay? You're going to pay pretty much anything at that point, reasonable, to cover your home while that storm's headed in your direction. It's wise to have it, just trying to use some type of explanation that people could understand what takes place in the markets. Terrible analogy,
Yeah.
but gives you an idea.
So, again, I blame Greenspan for all of this. I think if people really want to understand why we're so far over the tips of our skis right now, it's because he enabled a lot of behaviors. One, the speculative behaviors, saying, hey, if also the too big to fail thing, right? Long-term capital management, basically saying, hey, Wall Street, if you're going to screw up, make sure it's big enough that it catches our attention. Then we got you covered, right? So guess what? Everybody wanted to get bigger and take on more risk, right?
Right.
And then they had, this continued fostering of the speculative side of this, because Greenspan mistook, he thought we were facing this productivity miracle. He's like, he kept mumbling about that. Oh, we have so much productivity now. And productivity is just gross sales by gross inputs, right? So it's basically GDP by labor, if you wanted to look at it that way. And what he was confusing was that our manufacturing was offshoring, so we weren't doing the labor. At the same time, he was throwing funny money in, which made the top look good. So it's, of course, you have this productivity miracle, but it doesn't take a genius, let alone a maestro, to resolve that was just pure fiction, right? And they knew that. That's my complaint. They had to have known. They couldn't have been that dumb, right?
That's what I was getting ready to ask you. Do you really think that he didn't know that? They had to, but
Not a chance.
what's easier to tell the American people? Oh, we figured out how to make the markets be great, so your 401k's up. Instead of saying, yeah, we're shipping all the jobs overseas, and 20 years from now, you're really going to be hurting compared to other countries because we've gutted the manufacturing base in our country. And oh, by the way, if we do end up in a war, we've got to rebuild these manufacturing capabilities and onshore everything in a hurry, which makes us weak. There's
But
no
don't
way.
worry, when that future moment arrives, you'll have a president who will make your borders completely porous, and he'll drain your strategic petroleum reserve.
That's not funny, but sometimes there's things that are just so sad, all you can do is chuckle about them.
It's gallows humor for sure at this stage, but
True.
yeah. So here's another thing, and again, this is just purely for educational purposes. So I was asked a lot of questions this past week. I've had people calling me a lot about the concerns that were raised by the great taking, and many of the conversations ended on this one area here, which is, what do you think about gold and silver and things like that? And actually, gold and silver, I'll use those as a metaphor for real tangible assets that you can purchase and move across borders. Could be a lot of things that fit into that. Iridium, gallium, platinum, copper, but let's just use gold and silver as a moniker for that. I truly believe in my heart of hearts, Paul, that we now have something, I forget what the number is, 3,000 billionaires in the world. I don't know. There's that 0.1% I talk about. There's a lot of highly, highly concentrated wealth in the world.
Yes.
And so my position is that, while they keep silver sort of pegged at 22, give or take a buck, while they keep gold under, and they're doing heroes work, pull up a monthly chart. I'll do that. Just give me a second here. This is actually funny, watching how hard somebody is working to keep gold under a very specific number here. Go to metals, go to gold. Let me put this on a monthly basis, and let me share this right now. Here we go. So get rid of that. We don't need the ads, that's for sure. Get rid of that. So look at this, is on a monthly basis. This is gold. Here it is hitting back here in 2011, hit around the $2,000 mark. It just bumped right over that and got slammed back. Makes this beautiful from a technical standpoint, the cup and the handle. But look at this. Donk, 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 donk. They're working extra hard to keep this pretty well contained at this point in time.
And they've done a very good job, but there's also been buyers coming at higher lows. So, the question is the water keep getting deeper and the basketball keeps getting underwater? And at what point does the water get above the breathing ability of the powers that be that are holding it down? And then you see gold prices drop, spike up dramatically. Especially if we break out of that range, they're going to move quickly and strongly.
They will. And so here's my point. I maybe it's just fresh on my mind because I interviewed Mike Maloney yesterday for Off the Cuff, and that'll be coming out next week. And Mike has been in the business for a long time. And so my question is, I love talking to people who've got the gray hairs and just say, hey, I was there in 2008 when silver got absolutely mauled, right? It went from 12 to 8, right? Doesn't sound like a lot, but it was going to have to go back up 50% just to get back to even, right? It was a pretty big smasheroo, right? And it happened overnight in the Asian markets. And my metaphor at the time, Paul, was like, that's like a cattle auction went bad in Hawaii, and Oklahoma woke up and found out its cows were worth, 33% less,
Oh, that's a great analogy, Chris. That's very well done. I like that.
But that was the new price, And so I've watched these desperate games for a really long time, and I believe that they'll play the games until such time as the games no longer work. And then, so the question is, hey, what happened to your supply chains back then? Because barely anybody was invested in silver. There wasn't like a Reddit, silver stacking, Wall Street silver, thing. There weren't people posting pictures of their most recent junk silver purchase. None of that. It was a pretty small crew, and just that small crew, because I bought more. I'm like, yeah, I love cheaper silver. Yes. Even though I was annoyed at how it operated, I didn't like the market function, but I enjoyed the cheaper price. We crushed, you and I, and people like us, we crushed the silver supply chain. That's when I found out how thin it was, right?
Yes.
just a few diehard silver bugs went out, bought a few extra boxes or bags, and next thing you knew, it was like a 6-week wait to even get more. So Mike
Yes.
said, not only that, they ran out of gold. So he was one of the primary dealers in the situation, meaning they have a direct line to the mint. They've got
Okay.
direct line to the national warehouses. They couldn't get anything for weeks on end. Just no orders filled. Gone.
I remember the shortages because I was looking to buy gold and silver at the time and calling everybody that you can call. And there was one company I found that had some because they mostly deal with institutions, and then they started running into troubles later as well.
Yeah, so it's one of those great moments. Like, I live in a free country. Silver's $8 an ounce. You just can't have any. Like, it's not how this is supposed to work.
This is the price. We know you'll pay more for it if you can get it, but you can't get it. So we're going to set the price down here. I know it's just ridiculous. But the interesting thing is that the average individual who's not aware of what you've been educating, I remember calling people and friends, and I'm like, look, silver's been cratered. Buy any you can get your hands on. They're like, market's down, real estate's going down, silver goes down. So they're like, no, I think it'll go lower. I'm too scared to do anything, or the system's going to come apart. And so it's the rare individual that actually takes advantage of that, unless they've got somebody like you that's pointing it out, not as advice, right? But just, and myself individually, or those that you have educated so they understand those opportunities when they arise.
Yeah. And I just want people, if I can really emphasize, this is a tiny, tiny market. It's pathetically tiny. It's hard to get good numbers on this, but there's some estimate that there's maybe 1 billion ounces of investment grade silver out there. Great. Whatever it is today, I'll call it 22. At $22 an ounce, that means $22 billion owns 100% of the silver market across the world, which, just to put this in context, it's about half what Elon Musk paid for Twitter as a hobby project.
Yeah.
Right. So the point here is that if once those 3,000 billionaires say, I just want some exposure, it's over, right? And I think the one thing that we learned through all of this is that we don't live in a free and open, fair society. There are people who have unequal access to the law, to the financial products, so when the billionaires say, I want 1 million ounces or 10 million ounces of silver, they have a different pipeline than I do, right?
They do.
So point being, if you don't have some, you should. And, because I do think it's a light switch moment. We'll just wake up one day and, price will have gone up $40 an ounce on silver or something. But you won't be able to get it at that price.
No,
it'll be higher, but you'll have to wait 6 weeks, and then you wait 6 weeks, but guess what? You can't lock the price in with anybody because they won't do that. And 6 weeks later, it's now twice that. Oh, and there's another 4-week wait. Yeah, it'll be like people will be chasing that for a while because that's how the system is set up.
That's right. And from a long-term investing standpoint, now don't get me wrong, tactical investing means you're moving as you see things adjust, and that's very important with these manipulated markets the way that they are. But there's also a period of time where you look at certain investments and you say, okay, mathematically, this is where the ball's going. So think about it from this standpoint. You take an individual like Dave Ramsey, which I think unbelievably highly of. Okay, the impact that he makes on people and teaching them how to budget is incredible. But he is, openly states, don't buy gold. Right? You've got your major institutions. I know, without naming names, some of the other institutions are, will be like, we won't even buy gold for you, or we don't have any allocation towards it. So you take Bitcoin, for example, some of the major institutions are starting to offer products that are out there. We're starting to see that come into the mainstream. At what point does the price of gold and silver have to move before these institutions change their perception about that? And then you've got another dramatic move higher in the price once that takes place, because that's supply and demand. So those that are in with some as an insurance policy from a long-term standpoint, yes, you're going to have to be patient. But, I could argue that if gold was to break above this most recent level of support, the more energy that goes into that level and the more energy there is to take to drive that price down, once it breaks through, similar to the gamma squeeze we talked about, everybody's scrambling in the other direction to cover themselves, and that price moves relatively dramatically quickly.
Yeah. Well, I'm speaking like some old guy language here, because because I really believe in commodities, and the whole system has hated commodities. But it was years ago. I was talking with Jim Sinclair, famous finance guy, and he said, "Hey, Chris, it's the great pendulum. People move from fascination with things over to paper. We're in the middle of this big giant paper fascination, and then it'll go back to things again." And so I just want to make sure I'm on the right side of that pendulum swing, because fascination with all things paper, I think Bitcoin fits into that now, because it's kind of like it's a fantasy product in the sense of how Wall Street's going to manage it, right? They get to put ones and zeros on a hard disk that you see an electronic statement that says I own this thing. And that's easier for them to manage than a vault that has physical gold. They let's be clear, Western countries have been antagonistic to gold for a long time, in
Absolutely.
word and print. Yeah, they denigrate it, barbarous relic. They anytime gold goes down, Market Watch has a gleeful article, gold smashed, within minutes. It's how it's been for a long time, right? And I predict that will change again. But it's amazing how much we hate commodities in this country, like corn, wheat, oil, lumber, cows. I mean, it's been nowhere to be for my entire adult lifetime, right?
Yeah. Well, and those are the things that we have to operate in the society we have today. We need the foods to live on, to continue to survive and thrive as individuals. And I think we've taken for granted just the forces that have taken place in the industry. You have big industry comes into the farming. I'm not a big believer that any foreign entities should own any of our farmland, but they come in there and they drive the price down to try to drive out your local individuals. I mean, it's just business, right? I don't agree with the outcome of that, but it continues to drive prices down. We take it for granted, and it wouldn't take much to cause those prices to rise dramatically over time as well either.
Yep. So let me just pull this up, because I believe that this shift is already starting to happen. So everybody's heard about like that Bill Gates has bought a lot of farmland, right? But when we get to this whole idea of you'll own nothing, right? And owning farmland is really critical. So this just came up today. Reuters reporting, investment funds are stocking up on U.S. farmland in safe haven bet. So when we talk about investment funds, these are the people, they say here, and they have become voracious buyers of U.S. farmland, amassing over 1 million acres as they seek to hedge against inflation and But we're starting to see this money that Federal Reserve prints money, hands it out, gobs of it get created in the banking system. Some of it floods into these so-called investment funds, and then they go out and then they buy real stuff with it. When there's nothing more real to me than productive farmland. So this is already happening.
It's taking place. And, when you look at it from a long-term standpoint, you don't have to say it out loud, but if you really do believe that our currency is at risk and you're on an institution level, where are you going to go? You're going to buy those producing assets. Like you said, when Argentina's inflation, the assets didn't go anywhere. There were some assets that didn't do as good as others, but what are the most what are the most valuable assets? What do we need for society to function? Farmland, water, commodities, energy, oil. So you see a lot of these big institutions and wealthy individuals moving in that direction quickly, more so now than we did 15 years ago, when there were whispers about concerns about the collapse of our currency.
Yep. Speaking of which, purely educationally, I'm getting very intrigued with Argentina as a pick on the emerging side. Reason is there was a headline article came out 2 days ago that Exxon is looking to expand one of their pipelines out of what's called the Vaca Muerta shale play. So they have a shale play that looks like it may be as big as the Permian. Now, it's Argentina, shot through with corruption, really horrible laws, all of this and that. However, for Exxon to say they're ready to put a 60,000 barrel per day takeaway pipeline in, this changes everything for Argentina, because as soon as you can become an oil exporting nation, you're suddenly rich again. Like yes. Money is flowing in the correct direction. And that's happened not for so long that it is where it is. But this is actually a world-class play, is everything I've been studying about it. So I actually think that it's intriguing to me now, just eyeballing that. So hopefully Argentina can get its act together and, not trip on its own tied together shoelaces and somehow screw this deal up. But it's I just throw that out there as an intriguing thing for people to begin pondering.
Yes, and not only Argentina, but mostly all of South America. There's some very interesting potential opportunities in that area that have our focus and attention, because you're commodity heavy producers. You've got countries that can get along with the U.S. and the BRICS. So, it's always nice to have someone, if the U.S. is in negative relationship with the BRICS, that can do business with both, but they have the things that everybody around the world needs. And a lot of those countries' indexes have done nothing since 2004. The 2008 crisis collapse happened. And they're up a little bit from the bottom, but they really haven't gone anywhere for 15 or 16 years. So overlooked opportunities in that area are what we see.
Well, great. I have to cut this short because I'm about to go to another interview, which I'm very excited about. Everybody, you can watch that next week. It's with a gentleman named Simon Michaud. He is a professor of geology and metallurgy who does the resource view of, can we even do green energy as a concept? Is there enough copper, lithium, et cetera? It's just, everybody should be familiar with that. So I want to let people know that's coming. And we've been talking with Paul Kiker of Kiker Wealth Management. Again, if you want to talk to Paul and his team, go to peakfinancialinvesting.com and just fill out a quick little form, and somebody on Paul's team will get right back to you. You deserve to have a broker, a financial advisor, a financial planner who can speak your language. So, yes. Paul, thanks for your time today. Sorry we had to cut it short because I could keep going.
No worries, Chris. Always a pleasure. Look forward to the next interview too.
Excellent. See you next time.
Thank you. Bye.